Most people focus on what they invest in, but where you invest from can quietly cost you, or save you thousands over time. And the tricky part is, most people don't realise it until it's too late. If you're investing, or even thinking about starting, there's a decision sitting underneath all of that that actually shapes your outcome. Do you invest in your own name, or through a trust? And making that decision at the beginning is critical, because this isn't really about the investment itself. It's about how that investment behaves over the long term. If you're earning a decent income, building wealth, or thinking about retirement down the track, this decision can affect your tax, your flexibility, and your protection. And having worked in financial planning since 2008, this is one of those areas where people often get it wrong early, and then it becomes difficult to change later. So let's break it down simply. At the most basic level, you've got two ways to invest: in your own name or through a trust. If you invest in your own name, you personally own the shares, the ETFs, the property. Everything sits directly under you. Any income it generates gets added to your personal income, and you pay tax at your marginal tax rate. Simple, clean, easy to manage, but it's also fixed. There's no flexibility in how that income is treated. A trust works differently. A trust is a structure that holds the investments on behalf of people, usually your family. The key difference is this: the trust doesn't lock income to that one person. It can distribute that income. So instead of everything being taxed in your name, income can be directed to different people, often those on lower tax rates. But here's what most people miss. A trust doesn't change the investment, it changes the structure around it. Think of it like this: the investment is the coffee, and the structure is the cup. You can pour the same coffee into a mug or into a thermos. Same coffee, but very different outcomes over time. And this is where it becomes important, because that container changes how your money is taxed, how flexible it is, and how protected it may be. Let's start with tax. If everything's in your name, you're locked into your tax bracket. Higher income usually means higher tax on your investments. With a trust, there can be flexibility. Income might be distributed to a spouse or another family member on a lower tax rate. Over time, that can make a meaningful difference, but only in the right situation, because a trust doesn't automatically mean lower tax. It only works if there are people in your situation who can actually receive that income at a lower rate. Otherwise, you've added complexity without much benefit. Next, protection. If investments are in your own name, they're directly tied to you. If something goes wrong, legal issues, business risk, those assets can be exposed. A trust creates some separation. It's not bulletproof, but it can add a layer between you and the assets. And this matters, especially if you run a business or have higher personal risk. A trust gives you options. You can decide each year where income is directed. That becomes more valuable over time. As family circumstances change, income levels shift, retirement approaches. And having that flexibility later can be very powerful. But there's a trade-off. And this is where people often underestimate things. Trusts come with a cost. Setup fees, ongoing accounting, tax returns, admin. Where investing in your own name is straightforward, low cost, easy to manage, no extra moving parts. So you're really choosing between simplicity or flexibility. Neither is automatically better. It depends on your situation. Let me give you a simple example. Two people, same investments. One invests in their own name, earns good income and pays tax at their marginal rate. The other uses a trust and distributes income to a lower income spouse. Over time, that difference in tax can compound. But if both people are on similar incomes, that advantage may not exist. So the structure only works if it fits the situation. And this matters because once the investments are set up, changing structure later can be difficult. There can be tax consequences, costs, and complexity in moving things around. So getting it right early, or at least thinking about it properly, can save a lot of friction later. So what should you actually do with this? Start simple. Understand your current tax position. Look at your household. Are there different income levels? Think about whether flexibility would actually be useful or just nice in theory. Consider whether asset protection is relevant to your situation. And importantly, don't set up a trust just because someone said it's better. There should be a clear reason, because sometimes keeping things simple is the right decision. And just to say, this is general in nature, so it's important to consider your own situation before making changes. Speak to a professional. So to bring this together, this isn't about finding the perfect structure. It's about choosing the one that fits your situation today and into the future. Own name, simple and effective. Trust, more flexible, but more complex. The key is understanding what you're actually trying to achieve. If you want to implement this properly, I help Australians structure this every day. Details are below.